Anupam, back to you.
Thanks, Sandeep, for the very detailed presentation. And I have multiple questions, and maybe I'll start with the SIF one. This is first question is from Dhaval Luka that other AMCs are not aggressive on shorts. Quant has delivered returns. Will you continue to be aggressive on the shorts? Can we expect 3 to 4% leverage on this product over mutual fund in the long term?
See, first of all, we have to correct this definition. We have been aggressive. No, we are not aggressive. That is something you should understand. Quant is a very risk-averse house. When we are talking about we are able to deliver returns, we were able to capitalize the opportunity which market has given rather than saying we are aggressive. Okay. So difference between capitalizing a risk-adjusted return opportunity versus being a very aggressive. So I don't think that we should even try to, we talked about systematic active investing, which we talked about. We are not going to take unwarranted risks. Hence, there's no question of aggression. Yes, so far we have not gone average 9% short positions. As I always say, any product takes time to stabilize from our own compliance approval, our own risk approval, our trustee, regulator, everybody is watching. It's a new product. Over a period of time, as our system stabilizes, which happen up to large extent, and is a learning and the mindset which is to accept the short will get accepted, then obviously we will increase the exposure. But largely on the hybrid side, it will be low frequency. Active also will be on the shorter opportunity, which we talk about, where we have a better control. So with the call writing or the low risk derived strategy should be opportunity. There is no question of any aggressive view taking on the derivative route in this product.
Sandeep, next
Yeah.
question is from Rajesh Gada. Uh, that can you please explain the beta optimization as a strategy? And second part is, I think I'll take secondly. Can you explain this first?
See, let's understand without getting into any uh, definition of beta in terms of everybody understand the particular, let's say talking about Nifty. Nifty beta is generally considered standard one. If your portfolio beta, and again, I'm talking about portfolio beta, what you see in the fact sheet of the most of the mutual fund is wrong. Industry gives NAV beta. That's the reason our fact sheet we write separately is the portfolio beta. So if your portfolio beta is let's say 1.2, which means in a bull market, you will give better return and slightly bear market phase, you will underperform. Okay, that's a beta. It is not necessary, but that's a typical simple mathematical or simple explanation. Okay, like in our case, a beta was also low, still we have generated higher alpha. Okay, so the point which you're trying to understand, let's say 100 crores you have invested and you want to use 25 option, this naked short position route. First, you cut down your position. The moment you cut down your 100% exposure to 75%, you have cut down the exposure, which means you have cut down the beta of the portfolio by 20, by 25%. That's the first point. The moment you added another 25% short, that 25% short is going to cut down further your gross exposure, okay, or the net exposure. So that's the way, let's say beta becomes half. Though it's mathematically, it won't be exactly half, it will be somewhere closer to that number, just for the simplicity's sake. You are able to control the beta of the portfolio, which means you are able to control some risk of your portfolio, not completely, but you are able to control some risk. And that's the reason it's a interesting product, how you look at this product.
Sandeep, second part is usually equity SIF is considered as more aggressive compared to equity mutual fund. However, um, QSAF that in a bull market it will underperform the equity mutual fund. Please explain why.
Okay. So again, this is a myth, okay, that QSIF is more aggressive product than our mutual fund scheme. In fact, if I go by purely from a mathematical or statical perspective, this product is much more conservative than the mutual fund scheme by 25 naked short position options of the route available to us. You are cutting down your market exposure. So obviously it is more conservative than mutual fund scheme. That's the first point. Yes, in the mutual fund also you can cut down your exposure by hedging. Yes, that way you can cut down your beta also. But most of the people don't get into that business because if somebody is given a longer term perspective, then people say, why, who has asked you to hedge when market was moving up? So it's a very chicken and egg sort of situation. Here we are talking about a naked short, which also gives you alpha opportunity. So it's not a true hedging options available. And frankly speaking, QSIP as a product will be more conservative than our own mutual fund scheme. That's the way statically. What regulator defines that it is meant for more from a high risk risk appetite, not high risk appetite investor who have better financial equipment acumen to understand this sort of complex product. And that's the reason it has been explained this product should be not sold to the masses because they don't understand the derivative aspect. But I can tell you over a period of time, it's up to us how well we educate the real investors, both from a distributor perspective. The responsibility is there, even as a as a money manager, also we have responsibility how well we can explain these products. If we can do that, then after 3 years, 6 years later, you realize that risk adjusted return in 6 years later in the SI product or the QC will be, let's say, if I have to compare my own flexi cap versus my own, okay, QC long short flexi. Okay. So in 6 years perspective, again, from a longer term perspective, today's looks hypothetical, but the way we understand and data points are endorsing, 6 years later, you realize that quant long short flexi risk profiling will be far lower and possibly, and I'm using the word possibly even higher return than the mutual fund. Even the worst case you from you should be slightly lower than your flexi cap, but your risk will be far lower because you have not taken that risk. So that's the way mathematically I have to explain that. Hope I'm able to clarify that.
Thanks, Sandeep. I think Hemant want to understand the expense ratio, and I think the simple answer is it is similar to the mutual fund. So I think the next question is about the commodity fund that why there is no commodity in the AAA fund asset allocation fund, maybe based on the fact sheet of the
So
31st.
by 31st, it was not there. We have unwinded our trade, but in between, there were trade on silver side, there were trade on the crude side, there were trade on the copper side. But by the time at the end of the month, when you got the fact sheet, the exposure could have been cut down. Lesson is not there, but we are actively participating in these products also.
Sandeep, next question is from Vishal Doshi that can we divide rupees 10 lakhs within the multiple strategies? So
Answer is yes. Okay. What regulator says 10 lakh rupees per AMC. Okay. So if let's say quant has five SIF products, you can deploy 2 lakhs each in all the five products. So effectively, you have to maintain 10 lakhs in per AMC in all the SIF put together. You cannot combine three AMCs and this I have 10 lakh rupees. Per AMC limit is minimum 10 lakhs.
thanks, Sandeep. I think Sanjay Mehta wants to know that can we shift our mutual fund BAF investment into QSIF? So
So I think this is a very common question we get. If you want to do that, yes, you can do that. There's no issue. Okay. You can't just simply switch. You have to redeem here and then come here because switching option is not available between SIF and mutual fund. But our recommendation is that your incremental money should be deployed in the SIF rather than redeeming your existing one and shooting through the. This is more, but again, that's a very conscious call. Investor or distributor you should take on your own on based on your risk appetite, but frankly speaking, SI product is more meant for more conservative investor than the perceived perception about the SI because here I'm managing my risk better than the mutual fund scheme. So from a risk adjusted perspective, this is a greater, better product.
Sandeep, can you throw some light on the high frequency analytics briefly? Like I know that you have covered it, but if you can
So
throw it.
So when we talk about, see, let's understand why high frequency analytics. Okay, you are familiar with high frequency trading. What high frequency trading we do? We started. We were the first to start in 2008 itself in India in the high frequency analytics. High frequency analytics are people are the traders are playing only on the bid offer spread. So if you are seeing, let's say, in your ticker, you see on the CNBC only, let's say, last price. When you go to the broker terminal, you see five price, depending on what level of data he or she has taken. That you can drill down and see top 10, top 20. You can see the entire depth of the bid offer spread. So market makers or high frequency trader are playing on the both the sides. So they play for a few paisa thing, for few bips, they are trying to do this sort of arbitrage. That's a typically high frequency analytics play on the thing. When you get into high frequency analytics, the way we are talking about, we are also talking about, we are not talking about playing on the bid of a spread. We are talking about short term and medium term opportunity where we're trying to see how the rules are happening in a derivative market. Let's say rules reflection of your conviction. When you rule your leverage position, when you have highest conviction, okay? If there is arbitrage opportunity available, how the spreads are expanding or getting compressed, okay? How walls are expanding or getting compressed. So depending on, so multiple data which we use, let's say price is it's a continuous basis changing. Open interest is on continuous basis changing, okay? And so is the case volume on continuous basis changing. These are all high frequency. Let's say today, now you can also say company results, let's say uh, sales are also happening on live basis. Answer is yes, it's happening on live basis. Okay. But do they share the information? No, they share the information only on quarterly basis or maximum monthly basis. So despite their sales are happening on minute to minute basis, but they are not sharing the data. Any data which come with a lag effect are low frequency because it's not published on regular basis. Where anything which is public, weather is changing on minute to minute basis, okay, or rather second to second basis changing. These are high frequency. When you're talking about controlling the risk, okay, in the mutual fund or the SI perspective, then high frequency analytics will play a far important role because with the help of high frequency analytics or high frequency indicator, we are able to see with more clarity the shorter term and the medium term trend from a risk perspective. That's the way I will explain in a very simple manner.
Thanks, Sandeep. If you can answer this, can you please tell us the process? This is question is by Cable Kim Saria. That can you please tell us the process in shorts? Let's say you have an idea from your team, what type of stress tests you run on their results, and for generally how long you back test your quant and forward tests.
See, frankly speaking, we always said that back testing is not the best practice in the industry, though a lot of people do that. We as a house run through our own predictive analytic thesis. And if you understand, we have our own analytic platform called Quantamine, where it's a risk management and analytical platform. We run a lot of things, a lot of inbuilt things has been uh, built over a period last 30 years. And this is something which we feel very proud that over a period of time we have built this complex analytics, and we talk about a money flow analytics or volatility analytics or cycle analytics, okay, or how you look at macro analytics. So any sort of complex analytics we run through this system, which we have built is largely our own proprietary knowledge over a period of time we have gathered, and we remain very confident what we have built. And it's not something that we said this is perfect. It keeps on evolving, it's a continuously evolving process. So our team works on it and keeps on improving this system over a period of time. That's the way it operates. It's very difficult to quantify. Though we don't run any Excel sheet out here and then say this is what happens.
Sandeep, next question is from Samarth and also suggest if you're engaging in commodities other than gold, silver in the active asset allocator strategy.
Yeah, we recently participated in the oil, we participated in the uh, copper also. See, we also understand one thing in India, as SIF commodity side is also picking up. The trading volumes, which were significantly low in last few years, has also picked up. Let's understand gold picked up. Last year, silver moved the volume of silver is very meaningful now. Copper is very meaningful. Natural gas and crude are also reasonably good. So as liquidity keeps on increasing this market, it becomes easier for us because the impact cost comes down drastically. So for us, the impact cost matters a lot. And we are optimistic that we were able to capitalize on these opportunity which you get. See, let's understand the beta of commodities are significantly high. You've seen the price swing when you get in gold or crude is much. higher than the Nifty swings. So obviously, if you are able to capitalize these inflection points, you have potential to make money both on the long as well in the short side in a shorter span of time as compared to holding this position from a longer term perspective. So we are very open to participate in any of these products.
I think next question is by Saurabh in SIF offered by quant, which your scheme is high risk, high return schemes, and what are the CAGR we can assume in next 5 years in that scheme which you suggest?
See, obviously, when you talk about SMID as a portfolio, uh, being a characteristic of mid and small, is going to be more volatile and by default becomes more risky as compared to flexi cap or the long short flexi. But our hybrid product and even sector rotated thing is also more volatile because you're continuously running long short pairs. But on the low risk side, a conservative investor, our QSIV active allocator, the multi asset product, and as well as the hybrid product are low risk product. Okay. And hence, if somebody has low risk appetite, should capitalize on both the opportunities are far superior, tax efficiency also. But as far as looking at forecasting as a from a regulation perspective, and our compliance team don't allow us to talk about, and it become a very fertile exercise to say that what sort of return you expect. I think it's academic question in nature, depends on the environment which is prevailing. What is important to it that can we generate superior risk adjusted returns with this tool of 25% naked should think? Then answer is big yes.
Thanks, Sandeep. Next question is by Kushal Sardana that 10 lakhs invested value down 10% or say 1 lakh. I will be bound to put 1 lakh more or not? No, no, Kushal, you are not. But this is a passive breach and there is no need to put any money for that. And your next question is about the switches within the SIF scheme and it is allowed. Let's say if you put a money into a hybrid scheme, you can switch it into asset allocator. You can do that. Sandeep, next question is from the, I'll take a couple of questions for the FOF and FO. That if you're not putting money into credit funds, how are you planning to create an alpha in this scheme? I think you have explained that through the taxation, but again, if you can explain.
No, first of all, understand that when we are saying that this product we are targeting as a arbitrage plus, which means absolutely low risk. Okay. When we're saying we're targeting against the FD of the companies and bank, again, absolutely low risk. Okay. So when we're talking about low risk product or nearly zero risk product, okay, then if you start taking exposure in the credit risk or longer duration debt instrument, then you run higher risk. And that's one of the reason we say that we don't want to. And that's the reason we are very clearly saying this what we will not do. Apart from that, our active SO allocator is a very dynamic in nature. You continuously flip our opportunity wherever you see these opportunity, we'll try to capitalize. And obviously, tax efficiency is the most important tool as compared to bank's FD or as compared to company deposit. That that taxation benefit is available to us. Why we will not, as a mutual fund, not capitalize on that opportunity? And it's a great news for investor as compared to any banks. Here you get far superior returns with a similar risk profiling or rather low risk
Yes, thanks, Sandeep. Maybe I have a one or two more questions which have been left, and I think uh, one is from Avinash Mehta that are your SIF managed more like a long on MFs because drawdowns in March was there, rally from April onwards was used well by quant. So I think I thought I'll take this question.
So let's understand. We very clearly explain how we, if market falls, you should fall less. That should be the endeavor. But it should, you say that if it cannot fall, then answer is big no. It will fall, and obviously equity X100 will fall more. Equity long short flexi will also fall. As compared to that, hybrid will fall less, or active asset allocated will fall less. Purely the way you manage these products. Okay, we should be very clear. SIP is not any magic that now your downside is protected but upside is open. That's not the way. We have to understand from a risk perspective by hedging or by naked short. I am definitely cutting down my risk. Answer is yes. I'm able to control my beta. Answer is big yes. But there's no certainty to say that this will not happen. Okay. Now, the track record, that's the reason instead of showing you 1 month track record, we said whatever history is there, 6 months is the good track record to talk about. And over period of time, you will also experience how this product has performed. That's the reason I always said in on multiple presentation, please deploy your money. Okay, unless you experience it, you will never understand the importance or how SI actually operate. So it's very important. I'm not saying that you should go all out and put very aggressive exposure in this app because people are not, that education is required, awareness is required. So maybe you can start with that. So is the case that every client of yours should start depending on their risk appetite, their investment horizon. You can choose between hybrid or the equity long short products.
Mr. Murli Krishnamurthy want to understand that in the SIFs that investments and redemption is same like mutual fund. Mr. Murli, the answer is yes. In all the equity schemes, every day you can invest and every day you can redeem your money. In the hybrid schemes, you can invest every day, but exit is only twice a week because they are interval funds. Sandeep, I don't have many more questions, and actually, so just to give the dates for this NFO period for this quants income plus arbitrage active fund is August 17th to August 31st, and this fund is reopening on 7th. And you have very clearly mentioned that this fund is very well positioned towards all the investors who are having big time FD investments, and I think MFDs has an opportunity to go and get more customers who are more FD oriented. I think, Sandeep, with this, I think if you have a last words to say,
Yeah.
income
So
arbitrage.
thanks. And first of all, I'd like to thanks everybody in participating. My personal request to participate in this NFO was a very unique product in that sense. And though industry has launched this product, but I think as a distributor, if you're able to garner and shift money from the bank deposit, it'll be great news for your own investor. And most important, there's a quant. Why quant comes into picture? Because we have demonstrated that active money management, where or the dynamic style of money management, we actually specialize in active style of money management, and that is a big edge in this product because if dynamically we keep on rebalancing and switching, it can generate extra small alpha out here, and then that makes a lot of difference in some of these low risk product. Thanks a lot for participating, and I hope you're able to explain SIF part also. We will do a separate SIF presentation also over a period of time.
Sandeep, maybe as a last announcement, like this fund FOF is you can do it physical. It's available on BSE, NSE, and you can invest like any other mutual fund through our website also. Thank you very much, Sandeep, and thank you all the participants for your time and patience.
Yeah.
Thank you very
Thanks
much.
a lot.